Crypto showed up like a magic trick, not a normal product, not a normal investment. It arrived dressed as freedom, dressed as a weapon against the old system, and somehow you were supposed to trust it faster than your own judgment. Here's the uncomfortable truth most people avoid. Crypto didn't fail because the technology is useless. It failed because the psychology of the market never gets rewritten. The same human hunger for easy money, the same cartel behavior, the same incentive structure, just moved into a new costume. Let's talk about what crypto really is, what it promised, what it actually became, and why the revolution against traditional currency didn't land the way the dreamers said it would. You're watching this because you felt it. Maybe you bought. Maybe you almost bought. Maybe you got dragged into it by a friend who sounded confident, by a thread that looked like evidence, by a video that turned greed into spirituality. And even if you never touched a coin, you still saw the same pattern repeat: big promises, quick pumps, sudden crashes, and the quiet disappearance of money from small hands into big ones. Crypto is called digital currency, but that phrase is already a trap. It implies a simple thing: buy coin, coin goes up, you get richer. Real life is not that clean. Crypto is an asset class built on a narrative engine. It doesn't only move because of code, it moves because of attention, leverage, fear, rumors, and liquidity. In other words, it behaves like human behavior on a spreadsheet. At the center of the story is blockchain. A blockchain records transactions publicly and makes them difficult to alter. The pitch is elegant. No bank, no government, no central authority sitting above you, deciding whether your money is legitimate. This is why people describe Bitcoin as digital gold, why they imagine a future where money is neutral and rules are transparent. And yes, that idea is powerful. It hits a nerve that many adults carry quietly. You want out of dependency, you want to stop asking permission. You want a world where you aren't at the mercy of a single institution, a single committee, a single system that can freeze you without explanation. You want control. That desire became gasoline after the financial nightmare of 2008. When the system broke, the narrative around crypto became personal. People watched banks gamble with leverage, watched complex debt hide inside professional products, watched housing collapse, watched families lose homes and futures, while those responsible often kept wealth and influence. That anger was not stupid, it was accurate. The system did fail many people. The question is what happens when you put that anger into a new market with the same incentive structure. Bitcoin arrived like a direct insult to the old order. It promised that no one could print more of it on demand. It promised scarcity enforced by math, not by a central bank's press conference. That promise is why it caught fire. Scarcity feels like justice when you've lived through policies that make your savings feel smaller every year. Then Ethereum arrived, followed by Solana and others. Each wave came with a new fantasy. Smart contracts will automate trust. Decentralized finance will remove gatekeepers. Tokens will represent ownership, value, and future innovation. Every cycle offered the same emotional medicine. You were not just investing, you were escaping. But revolutions don't fail only because villains are clever. They also fail because the people inside the revolution still carry the same instincts. Humans don't stop being human because they bought a new ticker symbol. When crypto was small, it was closer to what the dreamers imagined. Early adopters were often developers, enthusiasts, and curious investors who took risks because they believed in the technology. In a tiny market, the movements feel raw. It feels like the community matters. It feels like you could get in early and stand on principle rather than power. Then the market grew, and growth is where the original dream gets eaten. When total value exploded into the trillions, crypto stopped being a fringe experiment and became a giant economic territory, and territories attract predators. The old money didn't need to reinvent itself, it just needed to convert its tools. This is where the revolution against tradition quietly turned into tradition with a new interface. Venture capital firms entered. They talk about innovation, but they're built to extract returns. They fund early projects, secure tokens at low prices, then wait for a moment when the public finally understands the story enough to buy. Once the crowd believes the dream, big players unload at scale. The emotional whiplash is almost guaranteed. The community sees the price jump and interprets it as progress, while the insiders see it as distribution. Asset managers joined. They don't care about freedom as a principle. They care about demand curves. They care about what kind of product sells to large institutions and how they can manage flows. When they move, it often isn't to liberate, it's to harvest. Even traditional banks and brokerages pivoted. After mocking crypto as a Ponzi scheme, they rebranded themselves as adopters. They published research, they offered custody, they launched derivatives. The point is not that every individual banker becomes evil overnight. The point is that the financial system is a learning machine. It learns how to profit from whatever the crowd is willing to hype. And then the most important lesson arrived, and it was brutally simple. In crypto, as in any market, who controls liquidity controls the outcome. Let's talk about one of the most damaging myths, that price equals value. In theory, markets should reward useful innovation. But in practice, especially in speculative markets, price is often the shadow of psychology. It's driven by expectations, by positioning, by leverage, by who needs to sell today, by how many orders sit on the other side of your trade. This is why crypto can pump violently from a single tweet and crash violently, because someone in a boardroom changed policy. Remember the famous moment when a major celebrity posted something minimal, and the market reacted as if a prophecy had been fulfilled? People saw it as evidence of influence from a single voice, but psychologically, it reveals something darker. The crowd is trained to respond to signals, not to fundamentals. When attention becomes the fuel, any spark can start a fire. Then a few months later, the same voice said the policy would change, and the price collapsed. The billionaire didn't break crypto. The market simply revealed its real weakness. It was never anchored to a stable value system. It was anchored to sentiment, and sentiment is fragile. Or look at the institutional story that was supposed to validate the dream. An ETF approval sounded like legitimacy, like the old world finally admitting crypto is real. The price would naturally rise, right? People built their hopes on that sequence. But after approval, the pattern shifted. The price didn't keep rising with the same momentum. Large holders had already positioned for liquidity. Once public excitement peaked, distribution happened. The dreamers call it market correction. The insiders call it harvest. Those of you who lost money might feel embarrassed. You might want to pretend you're smarter now that you see through the hype. But be honest, you weren't just buying assets. You were buying permission to believe you could escape the rules that made other people control your life. That's why the emotional injuries are so deep. They're not only financial, they're identity-based. You thought you found a door. Then you watched the door lead back into the same room. Now let's go deeper. Crypto didn't just become mainstream, it became engineered. One of the biggest reasons manipulation is possible is leverage. Derivatives are the hidden engine. Futures and options often make up the majority of trading volume, especially for major coins. That means a lot of the trading you see isn't investors buying with long-term conviction. It's people taking bets on price direction. It's positioning. And positioning creates a weapon. When large players open huge positions, they can push the market into zones where other traders get forced out. If enough leveraged buyers are trapped, a drop triggers liquidations. Those liquidations become selling pressure. The chart falls faster than logic because the market is not purely trading value, it's trading survival. Imagine the psychological experience of a small investor watching a chart. At first, they feel excitement, then denial, then panic, then numbness, then rage. Then the crash resolves into one simple reality. Their position was collateral damage to someone else's strategy. Now add another layer: rumors and fear. Crypto markets are addicted to narratives that travel faster than verification. Fear, uncertainty, and doubt are not accidents. They are instruments. A rumor about regulation, a rumor about a ban, a rumor about rate hikes, a rumor about something big happening. The crowd responds emotionally because they're trained to monitor and react. The market dips because people sell to protect themselves, and then the same parties that benefited from the panic buy at lower prices, only to sell higher later when the fear fades. That's not a mystery. It's a business model built on timing emotional reactions. Now consider the third layer, the platform. The dream says decentralized, but daily life happens inside centralized exchanges, and centralized platforms are not neutral. They control access. They can restrict withdrawals, alter terms, change risk policies, and in extreme situations, influence market structure. Even if they don't do it intentionally every day, the power imbalance still exists. The system's architecture can be decentralized, but your actual ability to move money may depend on an entity with discretion. Then there are stablecoins. These are the dollar-like tokens meant to reduce volatility. They are supposed to be the foundation of the ecosystem. But foundations can be fragile when you cannot verify the reserves in real time, when transparency is weak, when audits are delayed, when trust replaces proof. If stablecoins lose their backing, the market doesn't just adjust. It can collapse because everything built on their stability stops functioning. When the collateral fails, the entire ecosystem of trades can implode in days, sometimes hours. If you're wondering why this matters psychologically, it's because people conflate the existence of blockchain with the existence of freedom. They see code and assume it guarantees fairness. They treat transparency as a guarantee even when transparency is incomplete. The real problem is incentive. Incentives don't care about your ideology. Incentives govern who profits and who absorbs losses. And in crypto, those incentives still map onto the global financial system. Let's make this painfully clear. Crypto does not float outside macroeconomics. New investors often act as if crypto is a separate universe. It isn't. It moves with interest rates, with the dollar, with risk appetite, with oil shocks, with bank stress, with liquidity conditions. Crypto is a high volatility asset. In risk-off environments, people don't protect their speculative coins first. They protect their cash. When central banks tighten, the dollar strengthens. Funding becomes expensive. Leverage gets cut. Investors exit risk assets. Crypto, being a risk asset, becomes an early target. The emotional shock of this reality is harsh for those who treat crypto as a moral protest. If the entire narrative of freedom is true, then macro variables should matter less, but they matter a lot. When rates rise, crypto usually bleeds. When banks break, stablecoins can wobble. When systemic trust drops, liquidity evaporates. So the revolution fails in the simplest way possible. It was never insulated. Silicon Valley Bank failing was not just a bank story. It became a crypto story because some stablecoin reserves were exposed. That exposure produced a liquidity panic that didn't require new villains. It required only fragile assumptions. Crypto is often sold as a ship that can withstand storms because it's secure and transparent. But macroeconomic storms don't care about blockchain branding. Crypto can be a small boat that tips when waves arrive. It doesn't become immune just because you wrote the word decentralized on your website. Now let's talk about the surface of the market, because most people only see surface-level chaos. Every day there's another token, another revolutionary project, another community claiming they're early in the future of finance, gaming, AI, identity systems, whatever the hot narrative is this month. Under the surface, many of these projects share the same skeleton. New tokens are often controlled by investment funds or whales. They hold a majority of supply early. Sometimes they don't even hide it well. They just rely on new buyers not reading the tokenomics. Then they create demand using coordinated marketing, influencer endorsements, and social media campaigns designed to turn curiosity into urgency. The pump is not always random. It's often a planned migration of value from late buyers to early holders. When price climbs, small investors feel they're joining something special. They call it community. They say we're all early. They repeat slogans about decentralization and ownership. Then comes the exit. Early holders sell. Selling pressure becomes a slow-motion disaster for people who bought without an understanding of distribution mechanics. The tokens fall. The community blames market manipulation because blaming manipulation feels less painful than admitting they bought a product without a plan. Now add influencer marketing. Influencers are not just promoting tokens, they're selling identity. They provide a way for viewers to feel clever for believing. When an influencer says a token will change the world, your brain turns into a scoreboard. If you buy, you become one of the chosen. If you don't buy, you feel like you missed the train. This is why crypto attracts people with identity hunger. It's not just wealth dreams, it's belonging dreams. And belonging dreams are dangerous when they're used as bait. The more the market matures, the more this identity bait gets captured by older institutions again. It becomes less about freedom and more about access. Large organizations accumulate the assets that once symbolized resistance to them. When Bitcoin ends up in the custody of the same types of institutions it was supposed to challenge, you can call it legitimacy if you want. Or you can call it irony if you feel honest. But either way, the power map changes. The revolution becomes a market, and markets, especially mature speculative ones, tend to reward those already equipped with capital, infrastructure, and risk management. So what does this mean for you, the small investor or the person tempted to become one? Here's the part nobody wants to hear. Most crypto investors are not failing because they were unlucky. They're failing because they're being used by a system that selects for the least prepared participants. There are many reasons people lose money, but they rhyme. First is fear of missing out, the classic emotional trap. When a coin rises for several days and social media celebrates it, the crowd tells itself a comforting story. This time is different. It's just getting started. I can still buy before it goes higher. That's how urgency becomes manipulation. Whales don't need everyone to buy. They just need enough late buyers to exit. When the crowd floods in at the top, it gives early holders liquidity. Your entry is their exit. That's not a metaphor. That is the math of timing. Second is the misuse of leverage and the abuse of multiplier culture. Platforms advertise trades like they're games. The chart becomes a casino screen. People see Sex 20 and Next 100, and their brain interprets it as potential empowerment rather than risk. They ignore that leverage amplifies losses as fast as gains. They ignore that liquidation thresholds are mechanical. Leverage doesn't create profit. Leverage creates forced outcomes. It accelerates the fall when sentiment turns. Third is the lie of decentralization in practice. Many people say they hate banks, hate centralized control, hate the state. Then they leave their money inside centralized exchanges. They assume the custody they rely on is still freedom because the asset is on-chain. When an exchange fails or restricts withdrawals, people realize too late that custody is control. If you cannot access your assets when you need them, then the ideology was just decoration. Fourth is cognitive illusion. Most people don't understand what drives token price. They think price is a mirror of technological progress. Sometimes it is, but often it is not. Price is driven by supply dynamics, liquidity, derivatives positioning, and narrative velocity. You can have an amazing project and still lose money if the market sentiment flips. You can have a terrible project and still make money briefly if the narrative catches fire. That contradiction is the real education, and it usually arrives after the damage. Now consider the emotional cycle of a typical victim. It starts with excitement. A new story appears, and it promises not only wealth but identity redemption. It tells you you can be smarter than the crowd. Then you buy too late, or with too much confidence.